All right. In the last session, we have learned how to calculate the gross annual value, how to calculate the expected rental value, and then it comes to the net annual value. And you can see how to list the standard deductions and with the fall upcoming aspects. Now, in this session, just have a quick review. Just wait for a while. Yes. So in today's session, we will have a quick review to learn the upcoming numerical questions expects. So let's have, first of all, we have to learn that how to determine gross annual value. So first step is how to estimate the municipal rental value and fair rental value. Whichever is higher, that value will be considered. Then in step two, the higher value as well as the standard rent. So whatever the higher value came, so you have to compare with the standard rent, and whichever is lesser, that is the expected rental value, that is ERV. In step third, the expected rental value and the actual rent value, whichever is higher, that value stands for gross annual value. So let's begin some few numerical questions which has been left in the last session. And in today's session, we're going to learn that numerical questions which has been left. So let's begin. This is already done in the last session. So yeah, let's proceed. This is a question, numerical question where we have to estimate into three parts. So you need to calculate the annual rental value, and the three parts that we need to calculate is house was vacant for full years during the previous year. Second part is house was vacant for 2 months during the previous year. And the third is actual rent of the house is 4,000 per month and was vacant for 2 months. So automatically in the case A, there is no calculations to be put on as the house is vacant for the full years. So let's begin the calculation of annual rental value, which is here we talk about, in other words, we say gross annual value, right? So these are the particulars in case B and case C. So these are the figures which has been shown in the on the present slide, that is municipal rental value, that is 60,000 per annum, fair rental value, that is 66,000 per annum, actual rent is 7,000 per annum, and standard rent is 69,000 per annum, right? So now we have to estimate the gross or your annual value or annual rental value in the following two cases, that is case B and case C. So these are the particulars which has been estimated in case B and case C. The MRV is a municipal rental value which has already been mentioned in the question, that is 60,000 per annum. So whenever in the question is given per month, that is PM, alphabets P dot M dot. So it means you have to convert that monthly into the annually, right? So MRV, it's case B and case C, that is 60,000. In case B, we take up one case, that is case B, MRV 60,000. We considered MRV is 60,000. Then we talk about the fair rental value, because we need, in step one, we need to compare these two values. So whichever the higher value, that value will again compare with the standard rental value or standard rent, right? So in case B, that is 60,000 per annum. So we consider MRV 60,000, FRV is 66,000. So whichever is higher, the higher value is fair rental value, that is 66, then 66,000 value will be considered, and again this value will be compared to the standard rent. So standard rent in case B is 69,000 per annum. So 69,000 per annum is the standard rent. So again we have to compare whichever is lesser value is the expected rental value. So 66,000 is the expected rental value. As we compared, whichever is less value will be the expected rental value. Then again we have to calculate the actual rent. So how to calculate the actual rent in case of B? The actual rent in case of B is 7,000 per annum. So when we convert into the annual basis, then 7,000 into 12 months. So then it will convert into annually. So 7,000 into 12, that is 84,000. That is the actual rent that has been paid by the tenant to the SSC. So once we compare the expected rental value and actual rental value, whichever is lesser, whichever is higher, that value is called the gross annual value. So whichever is higher, which value is higher, that is 84,000, that is actual rent value is higher than the expected rental value, and that value is called the gross annual value, or in other words we called annual rental value. So 84,000 is a gross annual value. So now we have to follow up the format, that is in like we have to do the deduction, that is loss due to the vacancy period, then less any taxes to be incurred, then you have to deduct the standard deductions. So I in the question there is no values has been given except the loss due to the vacancy. The loss due to the vacancy is 2 months. So let's talk loss due to the vacancy is 2 months having a loss due to the vacant period, that is 14,000. How it could become 14,000? 7,000 into 2 months. So it convert into a 14,000. So when we deduct 14,000 from the gross annual value, we get the annual rental value, which is called 70,000, or which is estimated or calculated as 70,000 rupees. Then in the case C also the same procedure has been followed. The MRV at these values is very common and can be considered in case B and case C in both cases. And actual rent is 7,000 per month. So in the third case, we have considered the actual rent is 7,000 into 2 in the case B, and case C is already given the actual rent of the house is 4,000 per month and was vacant for 2 months. So 4,000 into 2, that is 8,000. So the actual rent which has been estimated, that is 4,000 into 12, but loss due to the vacancy, that is 4,000 into 2. So 4,000 into 2 in case of case C, that is 8,000 rupees. So whichever that how to estimate, that is deduct 8,000 from the gross annual value, we get the annual rental value, which is called 58,000 rupees. So in this question, this is the way how to calculate by follow up the format of how the calculation of annual rental value. So if you have any doubt, just let me know. So the same pattern of format has to be followed in 3 steps. Step 1, step 2, and step 3. So once you come up in step 3, you will get the gross annual value. So once you get the gross annual value, once if any deductions to be occurred like loss due to the vacancy or any standard deductions, we will get the annual rental value, which is called ARV. Let's proceed to the next question, that is calculate the annual rental value from the particulars given below. During the previous year, SSC could not really realize the rent for 2 months. Right, so this is the annual rental value from the particulars given below. So during the previous year, SSC could not really realize the rent for 2 months. So this is a particular details or description has been given in the present slide. So that is MRV, that is 60,000 per annum, FRV, that is 66,000 per annum, actual rent 7,000 per month, and standard rent 69,000 per annum. So this is a calculation that MRV is 60,000. FRV, that is fair rental value, is municipal rental value 60,000 and fair rental value is 66,000 per annum. Then FRV is 66,000, whichever is higher value is 66,000. Then again we have to compare this higher value with the standard rent. And what is the standard rent is 69,000 per annum. So 69,000 per annum is a standard rent. Then again we have to compare the higher value with the standard rent value. So whichever is less value is the expected rental value. So whichever is less value is the 66,000. So 66,000 is the expected rental value. Then again we have to compare the expected rental value with the actual rent. So now there is a need to calculate the actual rent. So actual rent is 7,000 per annum, but we need the value on annual basis. So you just need to multiply 7 actual rent into 12, that so that you can convert this value on an annual basis. So the actual rent is 7,000 and into 12 months. So 7,000 into 12, it comes to 84,000 rupees. So now when it comes to the actual rent, you need to also estimate the unrealized rent for 2 months. So from the actual rent only, you need to deduct the unrealized rent, the rent which is not being released, the rent which is not being paid yet by the tenant. So 7,000 into 2. Why? Because it 2, because the rent couldn't released for 2 months. So 7,000 into 2, that is 14,000. So once you get the unrealized rent, you need to deduct from the actual rent, that is 84,000. So 84,000 less 14,000, you will get the actual rent, that is 70,000. So whichever is higher value, that is the annual rental value. Because as there is no loss due to the vacancy, there is no taxes has been given in the question, there is no standard deduction has been mentioned in the question. So there is no need to less anything from the annual rental value. So annual rental value means whichever is higher value of the actual rent and the expected rental value. So what is the higher value is 70,000, that is actual rent. And when we compare to the expected rental value, that is 66,000, and actual rent value, that is 70,000. So when we compare these two values, we have to take the higher value, that is the actual rent value is 70,000. That 70,000 is the annual rental value. So this is a pattern of the calculations of the calculation of annual rental value, net annual value, or gross annual value. It is a very simple method to calculate these values. This is also the another question, which is the same format has to be follow up. You need to calculate the annual rental value from the particulars. The SSC couldn't release the rent for 2 months and also remain vacant for 2 months. That means it is also the loss due to the vacancy for 2 months. Also, you need to deduct, and also you need to deduct the unrealized rent for 2 months in case A. So when you talk of in case A, you need to actual rent, and that is the loss due to the vacancy. So loss due to the vacancy, the actual rent is 7,000. 7,000 into the loss due to the vacancy, that is 14,000. So you need to deduct accordingly. See, this is the loss due to the vacancy of 2 months. So 7,000, that is actual rent, and into 2. 14,000 is the loss due to the vacancy. You have to deduct from the gross annual value. So this is a way how to estimate, right? 7,000 into 10, 6,000 into 10. Why? Because it is already included in even the previous year 2019 to 10. 2 months is vacant. So the ultimately how many months that has been get the rent, that is 10 months. So 10 months will be considered in that. That's why it's taken 10, because the 2 months it's that SSC couldn't release the rent for 2 months. So the ultimately the balance months are 10. So 10 has been considered in this particular question. So any doubts in this question? If you have any doubts, just let me know. This is a question in case A. You need to calculate annual rental value. SSC couldn't release the rent for 2 months, and the vacant period for 2 months due to the previous year of 2019 to 20. Right? So SSC couldn't release the rent for 2 months. So 2,002 months rent is also deducted from the actual rent. Why? Because the actual rent has been considered for 10 months only. So 7,000 into 10, that is 70,000. And in case B, that is 6,000 into 10, that is 60,000. As you can see, what difference it would make if everything else remaining the same, but actual rent is 6,000. In case A, the actual rent is 7,000, but in case B, the actual rent is 6,000. See, in case B, that 6,000 into 10, that is 60,000. Everything is remains the same. Only the actual rent values differs, and as well as the loss due to the vacancies differ, because loss due to vacancy is 2 months. So 6,000 into 2 months, that is 12,000. So whichever is you have to deduct from the gross annual value loss, you will get the annual rental value. So any doubts in this question? All right. This is also the another question. So date of completion and date of letting out. So these are the dates. So you need to calculate the exact rent according to the dates. So this is accordingly you need to estimate. Right, so let's take up this question. Actual rental value you need to estimate. MRV, that is municipal rental value, and fair rental value. Actual rent is also given 6,000 per month. Standard rent is also given 63,000 per annum. Date of completion, that is 31st May 2019, and date of letting out, that is 1st August 2019. So let's begin the solution. MRV and FRV. So how many months has been considered? At date of completion is 31st May 2019. So there are 12 months, and the financial year begin from April. April and May will not be considered because that is the completion period. But after 31st May, we will count the number of months which being used in estimating the rental values. That is June. May will not consider because 31st May the completion period it gets over. So June, July, August, September, October, November, December, right? January, February, March. So there are only 10 months as the financial year ends as on 31st March. So the 10 months will be considered in this particular question. So the 10 months. So MRV, that is the value, it is 60,000 per annum. So 60,000 is MRV into 10 months by 12. Why? Because the completion period gets over on 31st May, and after 31st May, the number of months have been calculated in the whole financial year. So 10 by 12, that will be considered into 50,000. In fair rental value 66, again you have to follow up the same pattern, that is date of completion 31st May, the same value 10 by 12, 66,000, then it estimated as 55,000. Whichever is higher value, that value will be considered, and later on it will compare with the standard rent. So let's compare the MRV, FRV, whichever is higher is 55,000, that is the higher value. Now this higher value will be compared to the standard rent. So standard rent, of course, each rent will be estimated according to the you can say the months which being based on the date of completion. So that is 10 months by 12, that is 52,500. Whichever is less, that is the expected rental value. So higher value is 55,000 and standard rent value is 52,500. The expected rental value will become the 52,500. Now we need to calculate the next rental value, that is actual rent value or real rent value. So how it's been estimated, the actual rent value is 6,000 per month, and how many months it would be covered, that is 10 months only, because 2 months has been took for the completion period. So 6,000 into 10 months, that is 60,000. Whichever is higher value, that value we call annual rental value. That is annual rental value, it is 60,000. So whichever is higher is 60,000. So 60,000 is the annual rental value. As annual rental value is already estimated, but in the follow-up question is already given that you need to estimate the loss. So how many months has, due to the loss, due to the vacancy, it's 2 months. How it is 2 months? Date of completion is 31st May and date of letting out is 1st August. So 2 months is June, July. So the difference between the date of completion and the date of letting out the property, that is only 2 months. So the loss due to the vacancy of the particular property, it's 2 months. So 6,000, that is the actual rent, into 2, 12,000. So once you deduct the loss due to the vacancy period of the house property from the annual rental value, you will get the actual real annual rental value, that is 48,000 rupees. So this is a way to how to calculate the annual rental value when the date of completion period and the date of letting out period has been mentioned and is given in the particular question. Just have a look. This is a date of completion. Only the 10 months will be covered, and the date of letting out period is 1st August. So the 2 months in between, the difference between these two dates, the 2 months has been differs, and that 2 months has been considered in the loss due to the vacancy period. That is actual rent into 2 months. That is 12,000 rupees in total. This is the question. This is the solution. So in case you have any doubt related to particular question, this particular question, just let me know and you can ask your queries so that we can, after that, we can proceed into further questions. The same, you can say, format has been followed in each question. So you need to remember that the exact format. What is the exact format that need to follow up in the various questions. This is also the another question that is also given. Unrealized rent amount is already given. So from where you have to deduct, unrealized rent will be deduct from the real rent. That is also called, in other words, actual rent. And date of completion, that is 31st July. So what would be the period in the whole financial? How many periods left in the whole financial year is August, September, October, November, December, January, February, March. So that is 8 months will be given to let it out. See, 8 months has been considered out of 12 months, right? So let's talk about the, you can say, the loss due to the vacancy period, that how many, the difference between the date of completion and date of letting out the property is 30, date of completion is 31st July, that is a ending date, and the date of let out is 1st October. So how many months, what is the difference between these two dates, how many months would be gained? That is 2 months. How? August, 31st July is the ending period of completion. That means next month is August and September. And date of letting out period is 1st October. So August and September, only the 2 months has been considered due to as a loss due to the vacancy period. So 2 months, and the real rent is 8,000. So 8,000 into 2, that is 16,000. So 16,000 will be deducted from the annual rental value. So once you deduct the loss due to the vacancy, then you will get the real annual rental value. So this is a way how to calculate the annual rental value. There's also the another question is also given, the house tax and sanitation cess, the other taxes also. In this also is a municipal tax at 10% of MRV, and he paid 50% of taxes during the year 2019 to 20. So this is a question where now you need to calculate the net annual value. So when we talk about the net annual value, so while getting up the net annual value, you need to deduct all the taxes which has been mentioned in the question. So once you deduct all the taxes, you will get the net annual value. So let's begin this two parts, two cases, case A and case B. MRV is given 60,000 per annum and the date of completion is 1st July 2018. Actual rent received is 72,000 per annum. Tax levied by local authority and paid by owner, that is house tax and sanitation cess, House tax is 6,000 per annum and the sanitation cess is 1,000 per annum. So this is the question in case A. So let's begin with case A. Case A, that how to calculate the net annual value. MRV is already given to you, that is 60,000 per annum. So 60,000, the same value will be considered as it is an annual value. Then we talk about the actual rent receipt, because none, if we talk about the other rental values, it's not being given, right? So direct you can compare if no other values has been mentioned in the question. So actual rental receipt, or you can say actual rental value, is 72,000 per annum. So it's already given 72,000 per annum. So whichever is the higher value, that is the annual rental value, right? So if you see up the next question, we have given only in the present question we have only MRV and the actual rent receipt, that is real rent. No other value has been given, neither the standard rent value has been given, nor fair rental value has been given in this question. So automatically we can consider the MRV and the actual rental value. So whichever this higher value, that is called annual rental value. So once we get the annual rental value, whichever is higher value is annual rental value. So we have to deduct the local taxes from the actual rental value. So once we deduct the all taxes, we will get the net annual value. So what are the two taxes has been mentioned in the question? That is house tax, that is 6,000, and sanitation cess, that is 1,000. So these are the taxes which has been given in the question, and you need to deduct all these taxes from the annual rental value to get the net annual value. So house tax is 6,000 and sanitation cess is 1,000. So in total we get the 7,000. So once we deduct the 7,000 from the annual rental value, that is 72,000, you will get the net annual value, that is 65,000 rupees. So this is the solution of case A. So let's begin the case B. As the date of completion period is given, right? So of course there is no on this particular part, or you can see the terms has been mentioned is just for information. There is no use to include in the question, as there is no other information has been given, that is date of letting out. Let's talk about the case B, that is the calculation of net annual value. Now in this question, it's given date of completion 1st June 2019, and rent received, that is 4,000 per month, municipal rental value, that is 36,000 per annum, taxes 10% of MRV. So 36,000 into 10%. He paid 50% of taxes during the year 2019 to 20. So let's begin the question over here. So municipal rental value in case B, that is the date of completion is 1st June 2019. Why we have considered it here in 10 months only? Because in this particular question, the date of completion is 2019 and the financial and the previous year ending is 2020. So when the date of completion is begin from 2019 and the ending period is 2020, then we will start calculating the data or date of completion period and date of letting period. But when the date of when the ending period is 2020 and date of completion is 2018, then we will not consider any calculations related to the date of completion, because it is already, that is the base year, and this is the previous year, and this is the current year, that is 2020 in this particular question. So date of completion, that is 1st June 2019. So let's begin June July, August, September, October, November, December, January, February, March. 10 months. The ending period of completion is 1st June. So let's counting the whole financial year begin from the 1st June 2019. It's June, July, August, September, October, November, December, January, February, March. So that is 10 months. So MRV, that is 36,000, which is already given in the question. It's given MRV is 36,000. So 36,000 into 10 by 12. See case B. MRV is 36,000 into 10 by 12. Right? Because it is a case of 2019 to 20. That's why we have considered the date of completion. That's why we have considered the date of completion period in this particular case. In the previous case, the previous year is the date of completion is 2018, right? So 2018 to 2020 is the ending period. So it will not, the date of completion will not be considered, and there is a gap of 1.5 years or more than that. There should be a 1 year gap when we talk about the completion period. So in this particular question, there is a gap. So 10 months we have considered over here, and actual rent received is 10 months. So that rent received, that is 4,000 per month. So 4,000 into 10 months, that is 40,000. Whichever is high value is the annual rental value. So 40,000 is a higher value, right? So whichever is higher, that is annual rental value, that is 40,000. Then we have to deduct the taxes, whatever the taxes has been mentioned in the question. So the taxes are 10% of MRV. So here, this is actually paid by honor. 50% of 36,000. So what is the actual language has been given? Municipal taxes are 10% of MRV. He paid 50% of taxes. So 10% of 36,000 by 10 by 12. 10% of 36,000 by 10 by 12. This is the actual municipal taxes paid by the owner. But we have to consider over here 50% of this, 50% of the taxes. So whatever the taxes, municipal taxes calculated value has been incurred, you need to deduct 50% of the overall municipal taxes. So how it would be calculated? See, 50% of 36,000 into 10% by 10 by 12. So once we get the value, what is the value which has been given here is 36,000. 10% of 36,000 is 3,600 into 10 divided by 12. 36,000 into 10%, that is 3,600. 3,600 divided by 12, right? So it covers 3,000. The municipal taxes paid by the owner is 3,000, and we have to deduct, according to the question, he paid 50% of the taxes. So 3,000 rupees is a tax amount that the owner has actually paid to the authority. But we have to deduct 50% of the taxes. So 50% of 3,000 rupees. The calculation of this value is 3,000, and we have to deduct is 50% of 3,000, that is 1,500. Right, 50% of 3,000, what it comes is 1,500 rupees. So once we deduct the municipal taxes amount from the annual rental value, that is 40,000, it comes, the net annual value is 38,500 rupees. This is a way how to calculate the values. So in the question which is already given, in the question is already given, he paid 50% of taxes during the year. So we have to deduct only the 50% of taxes. What are the taxes? Is municipal tax of 10% of MRV. MRV is 36,000. 10% of 36,000 into date of completion period is 10 months by 12. So whatever the amount is scheme, that is 3,000, you need to deduct 50% of 3,000, that is 1,500. So this is a way how to calculate the values of taxes. Right, so this is the next question you can do on your own. It's very simple. There's also another question. It's very simple. Date of completion of house, and accordingly you earn 50% paid by tenant. So this is accordingly you need to estimate. Right, this is self-occupied interest on loan. This is on theoretical part, that how to estimate when there is a case of self-occupied houses and let out cases. So only one deduction of interest on loan taken to purchase, repairs, and renovate the construct the house plus 1/5 of the pre-construction interest. So it's already given before 1st April 1999 is 30,000, and after this date is 2 lakh, or actual interest whichever is earlier. And let out case is 1/5 of the pre-construction interest is allowed as deduction with no limit, and whatever the interest on mortgage is not allowed as deduction. So whenever interest on mortgage amount will not be considered as deduction, which is called the standard deductions, and unless the purpose of the loan connected with the house. If there is loan, any of the interest is connected with the house, then that interest will be calculated according to the pre-construction period. So this is a question, overview question has been given, where each and every MRV is also given, rent received is also given, taxes also given, fire insurance premium, ground rent, which is an expenses we can say, interest on loan taken to construct a house is already amounts is already given to you, interest on delayed payment interest is also given, that is 1,000, date of completion and date of letting is already mentioned here. So accordingly, you have to estimate the values here. So always be remember, when we talk about interest on pre-construction based on the pre-construction period, there is always the standard deduction under section 24. And what would be the standard deduction? It's given 20, it's 30% of the net annual value. This is a rule when we calculate the income from house property in the overall quotient. It is necessary to consider the standard deduction under section 24, and that rule says 30% of the NAV, that is net annual value, need to be considered and estimate, so that accordingly you can calculate the income from house property. Right? So there is a rule when we talk about the pre-construction is 1/5 of the pre-construction interest. So what is the interest of pre-construction? 15,000 plus 10,000. Then it covers that how to calculate the interest on pre-construction period. So this is a way, the 2 years is already given, the values is already given to you. So 15,000 and 10,000, it's already given. 15,000 plus 15,000 into 1/5. So you need to 1/5. That means you need to estimate the 1/5 of that, and accordingly you will estimate the period, the amount, that is 6,000 rupees. And once you deduct interest and net deduction from the net annual value, you will get the income from house property, that is 3,320. Right? 1912. Yes. There is some mistake over here. Let me check. 10,000 pre-construction interest, 15,000. Correct. Yes. If you have any doubts, just let me know. Read this particular information for your reference. We have considered a pre-construction self-required 30,000. So we have accordingly we took 30,000 in the question only. See, we have estimate 15,000 plus 15,000 into 1/5. So we have categorized because the two values has been given, 20,000 to 3 to 14 till 2018 to 19 and 2019 to 20. So we have covered this year 15, covered divided into two parts of 30,000, 15,000 plus 15,000 divided by 1/5 as per the rule of the pre-construction, plus 1/5 of the pre-construction interest. Right? This is also the another question which is given to you. So just try at your home and practice accordingly. Right? So the exact, you can say detailed format I've already explained in the previous session, of course, in today's session as well, and took the varieties of question so that you can understand the concept and used in the practical questions. So this is the answers, just the same follow-up to be, you can see, used in this particular question and same format as well. So these are the practical questions, right? Just gone through, read very clearly. First, before that, just read the format, then come to the questions. And the detailed calculation is already given in the solutions by me. This is also a full-fledged question, and this is a solution in a very easy way, right? That's it. It's like similar questions, not different question. It's a similar questions. Only the few parts of the question is new, and you need to understand that parts only, right? All right, so let's begin the new unit, or we can say the new block. So I will share this particular slide in the group. So just wait, yeah. So this is the new block. We can, and the name of the title of this session is all of the session is the income earned from capital gain. Right, so these are the learning objectives, that how to you can say calculate the capital gain and losses, try to understand what is the capital gain and losses, to understand the procedure and the format of the calculation of the gain or losses from the capital, to apply these concepts wherever is applicable in the real world, to analyze or to differentiate between the long term and the short term capital assets, and of course then how to calculate these capital assets in the real scenario, how, and you will learn the capacity of calculating or solving the problems in real terms. So let's begin one by one. So before you consider or like calculating or come to the numerical aspect, there is also need to learn that what is the capital gain and what is the capital gain tax. So few students say the capital gain tax is almost the capital gain. We cannot say exact the same, right? So capital gain is, what is capital gain? So when you sell any type of property or you can say land at a higher price, then it's the cost of acquisition, the cost that you obtain, right? The cost that you have bought, right? And on from them you will receive a profit or you will get the profit, and that profit is called capital gain. And it also called an income which is chargeable to tax. So when you sell a capital asset more than the original price, it's capital gain. When you sell any asset which is less than the original price, in other words, in the tax, in the income tax called the cost of acquisition. So when you sell any type of capital asset less than the original cost, it called capital loss, and that loss will also considered unchargeable to tax. Right, now we come to the what is capital gain tax. So the tax which is being imposed by the local authorities, by the municipal taxes or income tax authorities on the profits that you earn on selling that particular asset or capital asset, that is land, property, house properties, and the tax that is calculated on capital gains is called the tax on capital gain or capital gain tax. So the tax which is being imposed by the income tax authorities on the capital gain, that means the profit that you have earned on that selling up the particular asset, and that profit is being chargeable to tax, and that tax is called the capital gain tax. So while calculating the tax value or the income chargeable to tax, you need to understand there are two types of capital gains: the short term capital gain tax and the long term capital gain tax. So let's begin the that what is the exact meanings of these two terms. So before that, you need to understand the capital assets. What are capital assets? So capital assets are those particular properties which can be owned or transferred. For example, land, building, shares, patents, trademark, jewelry, leasehold rights, machinery, vehicles, etc. And there is also a list of assets that are not coming under capital gain. And these are the five cases: the stock of consumable or raw materials that for use in business, personal belongings which are of personal uses like clothes, furniture, or any other type of assets, a piece of agricultural land which are located in rural areas, special bearer bonds like we can say gold bonds, we can say 7% interest gold bonds in 1980s and 1977. There is also another category of the gold bonds, that is national defense. For the national defense, you can say people which have been issued by the central government only, which is will not come under capital gain. Gold deposits bonds, which has been issued under the gold deposit scheme or gold certificate, which has been issued under the gold monetization scheme, which has been notified by the central government in 2015. These five cases will not considered under capital gain. So in the question, if such terms has been used and you need to calculate the income from capital gain, so just exclude these items at the if in case you have included these items in your calculations, the practical as well as the theoretical aspects, then ultimately you are in the wrong direction. Right, so this is the meaning of capital asset. Now we come to the types of capital assets, that is short-term capital assets and long-term capital assets. So any assets which has been obtained and owned, right, for less than or equal to 36 months, it means 3 years, right, is short-term capital assets. If any assets that you have obtained, owned, or used for more than 3 years, it termed as long-term capital assets. For example, this means you sell the asset, right, within 3 years, a short-term asset. In some cases, the period of holding is reduced to 24 or 12 months, so that is also considered as a short term capital asset. So, let's talk about the special cases of short term capital assets. If the asset is an immovable property like land, building, or house, then the period of holding would be considered to be 24 months. This means that if you sell off such property within 24 months of buying it, the property would be called short term capital asset. Any asset that you buy, do sell off, or you can buy within the 3 years, it's short-term capital asset. Either it could be a recognized stock exchanges, either it would be any securities listed on the stock exchange, UTI unit, it's Unit Trust of India, any mutual funds products like zero coupon bonds, the bonds that you have, you will earn at the, you can say, 0% interest rate, and holding a period and having a holding period of 12 months, it's all called short term capital assets. So in short term capital assets, totally depends on the number of months. If it is 36 months or 3 years, it termed as short term capital asset. Long-term capital asset. Long-term capital asset are those which has been owned or obtained of more than 36 months and then sold off. Immovable property which is sold after 24 months, it's termed as long-term capital asset. So when we talk about equity share, there are so many, you can say, debentures, so many equities shares, so many securities, where we talk the debentures holdings. Mutual fund units, which are a holding period of 12 months, is applicable. If they are sold off after 12 months, they would also be called long-term capital asset, because these particular capital assets is under owned for a couple of years, and then you will sold off after 3 years or 4 years, so then also they will consider it long-term assets. So this is a special case. So if any of the equity shares or any of the securities or any of the mutual fund units which having a holding period of 12 months only, that particular asset is also termed as long-term capital assets. So capital gain is divided into two types: the short-term capital gain and the long-term capital gain. Short-term capital gain. Short-term capital gain are the profits that you earn when you, I already told you that any property that you earn more than the original price is, you can say, within the, you can say 36 months, within the 3 years, it's short-term capital gain, right? So these are the two cases which are applicable or which are not applicable. So when the security transaction is applicable, short-term capital tax is 15%. When the security transaction is not applicable, short-term capital gain tax will be calculated on the basis of the income of the taxpayers and would be automatically added in the income tax return of the taxpayer. Right, it's like classified into two categories. When security, when any transaction happened between the seller and the buyer and any security transaction has been applicable, then the tax on that transaction is 15%. If any security transaction is not applicable, so the tax will be calculated on the income basis of the taxpayer and will automatically edit in the income tax return of the taxpayer. Let's talk about the long term capital gains. So, long term capital gains are the profits that you earn when you sell off your capital assets post 1 year, right? So any asset which you have sell, and you are earning the profits, you can say after 1 year, that period is called long term asset. And this is a category when any secured transaction is applicable in case of sale of equity shares and the units of equity oriented funds. That any funds that you have, you can save for a couple of years, that the shares that you have owned from the company, it's you are sold off after a couple of years. It's also termed as long term capital gain. Just wait for 1 minute, students. Yes. So let's talk about the long term capital gain. Long term capital gain are the profits that you earn when you sell off the property after 1 year. So any period that you have a holding such assets are long term assets. So it depends, it also depends according to the type of the asset. It would be fixed asset or it would be current asset, right? So when you talk about any tax which has been imposed on the long term capital gain is always 20%, right? Whether it would be any kind of asset, but except these two, that is sale of equity, when we talk equity shares and the you can say equity oriented funds of any units. Long term capital gain are 10% and above on the sale of equity shares and unit of equity oriented funds. So when we talk about any asset, it's 20% tax applicable. And when you exclude the equity shares or any of the unit of equity oriented funds, it's the tax is applicable as 10% only. So that is the rule which need to be followed. Let's talk about the calculation of capital gain. So calculation of capital gain is always be depends upon that what type of capital gain you are earning. It would be long term, it would be short term. Short term is a different, it's calculated differently than the long term. And before you calculating, there are also different types of capital gain. So it's better you need to understand the concept of full value of consideration, because when we talk about the calculations part, there are various short terms, short concepts you need to understand that, because before that you cannot do the numerical questions. So it is very important by my end to make you understand that a small concepts which has been used or will be used in the numerical questions. Full value of consideration. So the full value of consideration, the money that you would receive when you transfer your capital asset, is full value of consideration, right? So in technical terms, full value of consideration is that consideration value which the seller has received or would receive in exchange for transferring his capital asset. So when you're transferring your capital asset and the money that you receive from the buyer, and that value is called full value of consideration. Now, under full value of consideration, there are two most important terms which we'll use in the numerical aspects, numerical quotient, that is cost of acquisition and the cost of improvement. Cost of acquisition means the cost, that the value that of the property that you owned and obtained, right? Full value of consideration, which is already told you, the value which has been the value you transferred, you can say for your capital asset. Cost of improvement means cost of repairs, cost of maintenance, cost of surcharge, cost of any other repairs and tools which has been used to recover, or you can say to improve the property. That is called the cost of improvement. Any doubts? Any doubts, Mubamba?
No, no doubt, it's clear.
All right, great. That is cost of acquisition. So the cost of acquisition is the cost price of the asset. It is the price at which you bought the capital asset. It's already I explained. Cost of improvement, the money spent on the capital asset to improve it. It would be any kind of repairs, maintenance. But if the cost of improvement is incurred before 1st April 2021, then it will not be added to the cost of acquisition, right? So if any expenses or cost incurred before 1st April 2021, because that is the rule, because that rule is to be followed in the numerical quotient, then such cost will not be added along with the cost of acquisition. This is the exact format, that is the calculation of short-term capital gain, the full value of consideration less expenses incurred on transferring the asset less cost of acquisition less cost of improvement. And then you will get the short-term capital gains. So this is an example, a short example to understand the concept that if there is any situation arises in the quotient, so you need to identify whether it should be a short-term capital asset or long-term capital asset. So let's start. Let's understand with an example. A house property was bought on 1st April 2017 for 50 lakhs On 1st January 2018, 5 lakhs was spent on making improvements to the house. Improvement is cost of improvements, right? On 1st November 2018, the cost property was sold for rupees 65 lakhs. So the house property was bought. The original cost of the house property is 50 lakhs. And the sold value, that is the sales value or full value of consideration, is 65 lakhs. Since the house was sold after 22 months, so if we count from 1st January 2017 till 1st November 2018, 22 months has been counted. So it would be categorized as a short-term capital asset because this that short-term capital asset should be within or before 36 months. So it is termed as short-term capital asset. Right? I will repeat again. Short-term capital asset. Why it is short-term capital asset? Because the house was sold after 22 months. And what is short-term capital asset? If you sold any asset within 36 months or before 36 months, it is called short-term capital asset. So this is a short-term. This house property is a short-term capital asset. So the gain from selling the house would be called short-term capital gain, and it would be calculated as follows. So you need to understand what is the full value of consideration in this question, what is the cost of improvement in this question, what is the cost of acquisition in this question. So the full value of consideration is 65 lakhs because that is the sales value of consideration. So the sales value of consideration is a full value of consideration. You need to deduct two costs, that is cost of acquisition and cost of improvement. Cost of acquisition is the original cost of the property that you bought. So that is 50 lakh rupees. That is the cost of acquisition. And the cost of improvement is 5 lakhs. So the cost of acquisition is 50 lakhs and the cost of improvement is 5 lakhs. So the short term gain is 10 lakhs. So you deduct 65 lakhs, 55 lakhs you deduct from the full value of consideration. So you will receive the short-term capital gain is the profit of 10 lakh rupees. That is 10 million. Right? So this is the overall but this is a format of the short-term capital gain. So this is a format of the long-term capital gain. So the full value of consideration, you have to deduct the all expenses incurred on transferring the assets, less index cost of acquisition, index cost of improvement, expenses allowed to be deducted from full value of consideration, exemptions available under section 54, 54EC, 54B, and 54F. And once you deduct all these expenses from the full value of consideration, you will get the long-term capital gains. So let's talk about what is the indexation of cost and what is the cost inflation index. We say CII. This is a cost inflex table, cost inflation index table, and based on this table we need to calculate the cost of inflated. This is the index cost of acquisition, index cost of improvement. These costs will be calculated based on this table. So before that, you need to understand the indexation of cost. Indexation of cost is done to such factors which are being faced by inflation over the years. So you can see if you're willing to sell off your property under inflation period. So that value is called the cost of indexation. Since inflation decreases the value of money and indexation of the acquisition cost and improvement cost increases automatically. When there is inflation, all the expenses would get increased. So The amount of these costs lowering, decreasing and lowering the capital gain earned, of course, definitely you will get less profit, even no profit as well when it comes to inflation. So to hold such a period, to hold such cost, we need to learn a new concept, that is cost inflation index. So cost inflation index is used to account for the inflation incurred over a holding period. That what would be the holding period under which we can hold our expenses, our profits, and our losses in that particular years. So with effect from the last budget, is already given, it is a real terms I'm telling you. With effect from the last budget presented on 1st January 2018, the base year for cost inflation index has changed from 1981 to 2001. That is why, when calculating the index cost of acquisition, CII of 2001 to 2 is taken into consideration if the asset was purchased before the financial year. If any of the asset has purchased before 2021, then CII of 2021 will be considered. That means cost of inflation index. So if, like for example, if any asset has been bought before 2021, so the CII will be considered of 2021. 2000, 2021 to 2, that is 100 cost inflation index will be followed or considered. Right? So let's take an example to understand the clarity. You need to check if any of the question, numerical question will be given to you. You need to check whether such asset would be the long-term capital asset or a short-term capital asset. Example is given to you here. A house property was purchased on 1st January 2000 for rupees 20 lakhs, and on 1st January 2005 repairs was done on the house which amounted to Indian rupees, that is 5 millions. On 1st January 2018, the house was sold for Indian rupees 75 million. A brokerage was paid to the broker, which was Indian rupees 1 million. What would be the capital gain amount? You need to check first that if the asset has been sold off, in how many months. So the asset was purchased in 2000 1st January, and it was sold in 1st January 2018. That means 8 years. That means it is more than 3 years. So it is a long-term capital asset. Right? But how to calculate the long-term capital gain? This is a particular process. So the full value of consideration means a sale value of the property of the house, and the sale value of the house is 75 lakhs. So 75 millions is this full value of consideration. Less index cost of acquisition, less index cost of improvement, less brokerage paid, that is expenses. Now, index cost of acquisition, what is the formula of index cost of acquisition? So the formula is already given to you. CII of the year in which the asset is sold. In which year the asset has been sold in 2018. Divided by or by CII, cost inflated index of the year in which the asset was acquired. Acquired means the asset was purchased. Right? That is purchased is 2020 lakhs. So if we talk about any assets which has been bought before 2000 year, that means the cost of inflation, the cost of inflated index would be 2000 to 2002. See, there is a rule, have I already told you. When calculating the index cost of acquisition, CI of 2021 to 2 is taken into consideration if the asset was purchased before the financial year 2021 to 2. So the asset is purchased in 2000. So purchased is before 2021. So the cost inflation index would be considered in 2021 to 2, that is 100. And 2018, this is 17 to 18. 2272 will be CII. So when we divide the cost, right, 20 million into 272 by 100, you will get 54,040,000. Any doubt in this, student? It's very simple. See, the cost of acquisition formula is CII of the year in which the asset is sold divided by CII of the year in which the asset was acquired. That means asset was purchased, right? So the cost of acquisition into CII of the year in which the cost of asset is sold by or divided by CII of the year in which the asset was purchased. So 20 lakh is a cost of acquisition into CII of the year. What is CII of the year in which the asset is sold? That is 2018. So what is the CII of 2018? Let's say 2018. This is a 2018. This is 17 to 18, right? Why it's really
So
2017? 2018, why it has been considered 272? Because the asset has been sold in 2018, 1st January 2018. So if we talk about the financial year of 2018, that is 1st April 2017, and ending period is 31st March 2018. So the financial year will be considered in the sold case, that is 2017 to 18, and that's the values in cost inflated index is 272. See, that's why it's the cost inflated index is 272 according to the year or has been mentioned in the question. Right, so that's why it's written 272 is a sold and 100 is a purchase CII. So 20 lakhs into 272 by 100, you will get the value is 54,040,000 rupees. The list index cost of improvement. So you need to check the cost of improvement. What is the year of cost of improvement? It's 1st January 2005. It means 2004 to 5. The CII will be considered because it's 1st January. So what is the financial year? Beginning year is 2004, 1st April 2004, and the ending financial year is 31st March 2005. So 2004 to 5 will be considered. That is 2004 to 5, that is CII, it is 113. Right? 2004 to 5 is 113. So use the formula, is the same formula to be used. Cost of improvement into CI, cost inflated index of the year in which the asset is sold divided by or by cost inflated index of the year in which the asset was improved is equal to 5 lakh. What is the cost of improvement? Is 5 repairs was done on the house which amounted to 5 lakhs. 5 lakhs into 2000, 5 lakh into 272 by 113. Why it is 272? Because the sailed year is 2018 and the same CII value will be considered. The 5 lakh into 272 by 113, and the value that we have been on calculated is 12,003,540 rupees. right? And the brokerage fees. What is the brokerage fees over here? The brokerage was paid to the broker, which was Indian rupees 1 lakh. So 1 lakh is a brokerage paid, that is expenses. So whatever the expenses has been incurred during the property is should be deducted from the full value of consideration, that is 1 lakh. So once you deduct all these three values from the full value of consideration, you will get the long-term capital gain, that is 7,056,460 rupees. So this is a way to calculate the index cost of acquisition. So once you get, you will added the word indexed. So you need to follow up the index inflated table. This is the table. And this is a formula. Cost of acquisition into CIA of the year in which the asset is sold divided by CIA of the year in which the asset was purchased or acquired. Same for cost of improvement, right? So any doubt in this question, please ask if you have. Any doubt in this question?
So when given the same question, would the inflation table be provided?
Yes, this table will be given in the question, right? If it is multiple choice question, the table will be the value of the in respected of the years will be given in the question. If it is not given, you can ask for the table, right, from the invigilators or anyone. They will get the table, and accordingly you can use that table and estimate the value of index cost of acquisition and index cost of you can say improvement. Otherwise, if the table is not available, you get the photocopy of this table along with you during the examination. There is no problem in that. You can take the printout of this table, go in the examination hall, and you can use this table while calculating these values, items, right? Is it clear?
All right, thank you. It's clear. Thank you.
All right. Let's proceed a few more slides so that we wind up this particular session. I believe it's already end up. Right. So this is all about the capital gain, right? So let's proceed for a few more topics. So let me end up this. Just wait for 1 minute to open this new slide, new particular chapter. Income tax practice in law is all about the rules. If you remember the rules, you can easily do the practice. What's the problem going on? All right. These are the notes of income from capital gain. You just gone through this. Whatever I taught is the same is being written over here. See, index cost of acquisition, index cost of improvement. So whatever I've taught you, short-term capital gain, long-term capital gain, the same procedure has to be followed, right? This is an example to being given over here. I believe you will already know how to calculate the depreciation, right? Opening stock plus add asset purchased, then we total it, then we deduct the asset sales and the written down value method for depreciation. Right, so these are the examples, the values which has been given. So if we talk about depreciation, this case one, right, it's covered under in profit and gain, business and profession. This is a theoretical part, and no depreciation will be given in the short term. This is a short term capital gain, right? So if you have, in case B, if you see the difference over here, so there is a, you can see when you get the written down value for depreciation in the negative value, you will get a negative value under WDV. It is termed as short term capital gain. If the written down value of depreciation gets positively, that gets a positive value, that means this is a short term capital loss, right? That is a short term capital loss. Any doubts in this? See,
No, no doubt.
in case second and third, if you get the depreciation value using a written down value method in negative value, it's a gain, short term capital gain. If it is positive value, it's a loss when it comes to depreciation concept, right? So this is a special like capital special cases, just gone through this theory and along with the practical question which I already taught you, right? It's the same practical question which has been followed up. It just gone through it, you can easily understood very well in a very simple language, easy language. These are the notes has been prepared by me, right? So just gone through these notes. If you have any doubt in this, just let me know. This is a all theoretical part, and the multiple choice question will be asked for more in the theoretical aspect. Numerical question will be asked, right? From the capital gain, house property, and salary part as well. So these are the notes of 8 pages, just gone through it, and definitely you can mark all the correct answers in respect with the in this particular block or unit, right? So this is also a chart given over here. Capital asset, property of any kind, does not include, what does it include in that, what does not include in that, which I already taught you in the slides. Of course, in the notes as well, it's also written in the same manner, right? So jewelry, agriculture, land, whatever, it's not included under capital gain. So, in case any doubt in this particular unit, income from capital gain, any doubt you would like to ask, because the session has already been ended up, right? So, already whatever the topics which has been covered is already taught during the slides, and of course in this particular note. So if you have any queries, any doubts, just let me know so that we can cover up that doubts and we finish the this session. Abdul and Ukwu.
That me, I don't have any question.
Sorry, Abdul, your voice is not audible.
Me, I don't have any questions, sir.
Abdul, I cannot hear properly. Could you say it again? Um, I can't be able to hear Abdul because your voice is so loud and disconnecting with you. Okay, all right, I understood. Okay, Abdul, these are the notes which has been, you can say, have been made by me for the learners so that once you've gone through these notes, you can easily appear for your final examination. And the notes are equally important for the learners, as well as the slides are also equally important. So before you come to the notes, I would suggest to all students who are present or not present in this session, who are present or not present in this session. So I would suggest you to first go through the PPTs and then read the notes so that you can easily cover each and every topic of the block, and you can easily revise it again and again, and you can appear for the examination to score better, right?
All right, sir. Please, where
All
we
right.
will get the because I need
Yeah,
to hear you clear.
so you look into it in the upcoming days. So if you have any doubt, just let me know, right? I can clarify your all doubts. So till then, I will share these notes into the group. You just gone through, and just if you have any query, then let me know. Till here, I would like to wind up this session, right? So in case of any issues on related to the topic, you have in the WhatsApp group, you can ask, or in the WhatsApp you can ask your queries, so I can easily clarify it, right? All right.
All right, sir.
Um, Take care. Have a good weekend. And see
Sir,
you on the
which
next
number?
Monday.
I say, sir. Hello, sir.
All
Which
right.
number
Take
you use?
care.
Okay, all right, sir.
All right. Take care. Bye.
Thank you. Thanks for all.